The most common question I see in comment sections or from people I speak to is, how many stocks or funds do I need? So in this video, I'll help you decide whether you have too many or too few investments in your portfolio. With investing, the obvious goal is to make as much money as possible. And we know that we need to balance risk with returns. And we're told that in order to balance that risk, we need to diversify. Diversification is the idea that if we can add investments that are not correlated, it means that if one investment goes down, another investment might be on its way back up. And we can do this across a portfolio. It means that we can reduce the amount of risk that we have and reduce the volatility in our portfolio. This is why active fund managers managing mutual funds will have anywhere between 50 and 500 investments in the fund. They're trying to manage the return with the volatility of those investments. But how much diversification is too much? I think we see complexity as this badge of honor. We think that the more things that we have in our portfolio, the better. And we think that the more that we can add, we're going to get a better return with reduced volatility. And it's far too simple just to have one fund. I need to add multiple because I need to cover every situation and every possibility that might occur. But really, when we think about it, who are the main benefactors of this complexity? For me, it's usually the advisors and the financial institutions. It's far too simple just to tell people, just invest in one fund. There is, of course, an element of fees by putting people into multiple investments, but it also makes it seem a better investment by having your money spread across multiple funds. I think we fall into the trap of seeing a fund exactly the same way that we see a stock. Now, I think most people know that if we invest into one company, we take on a lot of risk with that one company. And when we think about diversification, we think, all right, we need to invest in multiple companies, maybe in different sectors, maybe in different regions, even different countries. And I think when we think about funds, we have the same mindset. But actually, when we break down what is in a global index fund, if we take Vanguard's FTSE All World Index Fund, this is a global index fund that's going to track over 3,600 companies. You're going to get exposure all across the world in different sectors, different regions, different countries. And it's market cap weighted as well. So this is constantly being updated. So if a company increases in value, then that will get a slightly higher percentage, like slightly higher weighting of that fund. And that's constantly changing. So if you invest into a global index fund, you are already diversified. The fund is doing the work for you. That's why they're so popular, because you don't have to actively pick a country or a sector or even a specific company. You can just invest in the world and let the market weighting, the natural flow and movement of the global economy do its thing. And I think most people will start out with this approach. If they're new to investing, they'll usually get into either a global index fund, or they could also get into an S&P 500, one of the most popular index funds over the past few years. And then what we start to see is people adding more stuff to their portfolio. So they might start with, say, a global index fund. Then they might say, oh, actually, I want the S&P 500 because I can't choose between global and S&P. Or actually, I've seen tech stocks doing really well in the last decade. I'm going to invest in the NASDAQ 100 as well, which is an index fund of the most popular tech stocks. And then I might have some other active investments as well. So I might have some single stocks. I know Nvidia's done really well recently, so I'm going to add that to my portfolio. And maybe I want to balance this out. So I'm going to pick some emerging markets because I know that they can potentially have some increased returns along with increased volatility. But I know because I'm well diversified now, I can add more of that to my portfolio. And then over time, we end up with this investment portfolio that's got 10 different funds in, some index funds, maybe some active, maybe some single stocks as well. And let's take that global index fund. The United States makes up around 65% of that global index fund. So if we then invest in the S&P 500 as well, say for example, we had a 50-50 split, half S&P, half global index fund. Instead of having 65% weighted to the US, we're now going to be around 80 to 85% in the US. So there's a massive overlap there. Then if we add in the NASDAQ 100, that's going to be the top tech stocks. You've got the likes of Nvidia, Microsoft, Apple, Amazon, Google, etc. They are also going to make up the largest amounts in the S&P as well as the global economy because they're just the biggest companies in the world. So then we're actually having a higher concentration in those stocks as well. And that's before we even start investing into single stocks like Nvidia. You can, if you want, try and create your own global index fund. So for example, you could, rather than just going into the world, say, right, I'm going to have the S&P 500, that's going to cover my US side. Maybe I'll have some FTSE 100 to cover the UK, some European. Maybe you will have some emerging markets, Latin America, some Asian funds as well. And you could create this portfolio that essentially does the same sort of thing as the global economy. But because you've got that freedom, say you have 5 or 6 different index funds, you could select different percentages, and then it's up to you then to select what weighting you want to have in your portfolio. And I'm not necessarily against that approach. All you're doing with that is having more control yourself but you also take on that risk as well. Because what you're generally saying is, I know that I can beat the market. And I want you to ask yourself, what gives you the impression, or what information do you have that you feel that you can beat that consistently over the long run? And how active do you want to be? With a global index fund, it generally gets reweighted every quarter. But if you're having this active approach, think about how often do you need to change the weighting? When you're investing into the fund, are you going to have an equal weighting about how much you invest into each one? Are you going to weight it depending on the size of them? There's a lot more that goes into that approach, and that might be something you enjoy. And I think we can't take that away from investors who like that approach, because yes, of course, investing is about making as much money as possible. But also, I think if you can get joy out of selecting these investments, then that's something as well. Now, that's not always going to be the best approach for most people, definitely not. But I just wanted to give you another option other than just going down the one fund route. For me, I use a global index fund because I want the most hands-off passive approach. I want the world just to do its thing. If I go down an active approach, it's really hard to know where to draw the line, because I could say, right, over the last 10 to 15 years, the S&P 500 has outperformed a global index. So if I then say, okay, I'm going to, instead of just investing in the world, I'm going to do the S&P 500. Then within the S&P 500, you might think, oh, okay, actually over the last decade, within the S&P 500, the tech stocks have done really well. So actually I'm going to invest in them. So I'm going to invest in the NASDAQ 100. And then within the NASDAQ, you might look at something like Nvidia and see how much it's grown in the last few years and just say, all right, I'm going to invest in that. And when you have that active approach, so you start at a global approach, and as soon as you start selecting a specific region, country, where do you draw the line? Because you can keep going further and further down the line until you're essentially just investing into one company. And there's not necessarily a right or wrong answer here. It's going to be what works best for you. But remember, it all comes back to the same goal. Every investor has the same goal of making as much money as possible. Now, everyone's going to have different risk tolerances, and some people can afford to take on more volatility than others, and that's going to affect their investments. But always ask yourself that question: can I beat the market? And can I beat the market over the long run? And don't fall into the trap of thinking, oh, I just have one fund. Is that enough? I see other people having multiple ones. Because sometimes simple is best. What a lot of investors I know that invest into global index funds, what they'll usually do is have a high percentage weighted towards that index fund. So 80 or 90% of their investment portfolio in that global index fund. And then what they sometimes do, because they're a little bit more interested in investing and allocation and that kind of thing, they will do some single stocks on the side. But because it's such a small percentage of their portfolio, there might be some overlap between that global index, but it's not enough really to skew the results. It's more about a bit of fun. It's their interest, and that's absolutely fine. And that's what I'm trying to get, that balanced approach. Let me know your thoughts below. Do you have one fund? Do you have multiple funds? Do you have multiple stocks? What does your makeup of your investment portfolio look like? I'll leave a link to my recommended investment apps down below. There's some really good welcome offers, so be sure to check those out. Hope you found that useful, guys, and I will catch you in the next one.